Welcome to today's Explainer. Right now, Wall Street is doing something that looks, well, incredibly reassuring on the surface, but when you dig a little deeper, it's completely contradictory underneath. We are currently looking at a stock market that feels perfectly calm. But we've got to ask, is it genuinely confident, or has it just become totally oblivious to the risks out there? In this Explainer, we're going to break down exactly what the data is telling us about this bizarre market tranquility. To really understand this calm, we first have to look at the sheer strength of the market. The S&P 500 recently closed at a staggering 7,798.99. That is massive. We saw a 4% rally in August alone, including a nearly 6% surge over just 4 days. Investors are rushing in right now, and honestly, the optimism is palpable.
But then we have this number, 14.56. That's the VIX, which is basically Wall Street's fear gauge. And at this level, it's remarkably low. It's like the surface of the water looks completely still. Everyone seems relaxed, and money is just flowing effortlessly into risk assets.
Which brings us to probably the most absolutely crucial question we can ask right now. Is Wall Street genuinely confident about the future of the economy? Or is the market simply becoming dangerously comfortable? Because here's the secret about financial markets. Genuine confidence and dangerous complacency, yeah, they can look exactly identical, right up until they don't. So, as we know, the VIX tracks expected 30-day volatility. But sitting way down at 14.56, investors are essentially just shrugging their shoulders at global debt, sticky inflation, geopolitical tension, you name it. The market expects clear skies. There's seemingly zero urgency right now to brace for any sudden, massive moves in the near term.
But here is the mystery hiding just beneath that calm surface. While the VIX is taking a nap, the CBO SKEW Index has quietly crept up 6.6% since July. That tells us someone is making very, very deliberate defensive moves behind the scenes.
Unlike the VIX, which tracks ordinary day-to-day bumps, the SKEW Index prices in tail risk. It tracks the premium investors are willing to pay for protection against extreme, disastrous outcomes. And right now, well, they are quietly paying up. So they definitely haven't forgotten about risk entirely.
It's a brilliant contradiction, honestly. On one hand, the VIX expects a perfectly sunny day. On the other, the SKU index is quietly packing an umbrella and, actually, scratch that, it's more like it's building a storm bunker. The fascinating thing about sophisticated markets is that they can hold both of these thoughts at the exact same time. Investors can expect broad stability while simultaneously hedging their bets against total disaster.
The best way to really wrap our heads around this behavior is through a simple house insurance analogy. When you buy insurance for your house, you aren't doing it because you confidently predict your house is going to burn down tomorrow. Obviously, you fully expect it to remain standing. You buy the insurance because you are terrified of the catastrophic financial cost if it does burn down. And that is exactly what the options market is doing right now. It's not a crash prediction. It's a structural safety net.
So what's driving the market so high that people feel the absolute necessity to buy this really expensive insurance? Well, a massive part of it is the sheer gravitational pull of FOMO, fear of missing out, supercharged by the whole artificial intelligence narrative. As markets rise, investors sitting on the sidelines feel the pressure mounting. They see these AI giants rallying, they scramble to jump in, and this creates a fierce, almost self-fulfilling feedback loop. Higher prices create optimism, and that optimism demands more buying.
But this creates a massive expectation trap. Think about the sheer scale of the AI boom right now. We're talking unprecedented spending on data centers and chips, alongside absolutely enormous valuations. The market is essentially giving these companies credit today for successes they might have years down the line. Investors are actively forcing the question, is all this astronomical infrastructure spending actually going to generate enough future profits to justify today's sky-high stock prices?
To really grasp the whole picture, though, we need to zoom out from equities entirely. We've got to look deeper, beneath the surface of the stock market, at the broader macroeconomic iceberg lurking in the background. Because let's face it, stocks do not exist in a vacuum. They are deeply and relentlessly affected by the cost of money, the cost of goods, and the overarching policies that govern the entire financial system.
Let's check the vital signs of those external pressures. Long-term borrowing costs are high, with 30-year Treasury yields sitting at over 5.1%. That puts immense pressure on high-growth companies. Meanwhile, oil is sticky in the high 80s per barrel, which keeps energy inflation elevated. And you know the Fed is watching all of this like a hawk. These aren't just abstract economic concepts, they're daily, tangible threats to that delicate market calm we've been talking about.
This brings us to a really powerful realization for your own portfolio. As the old saying goes, the higher the market climbs, the more important future expectations become. When borrowing costs are up around 5% and valuations are breaking records left and right, a company simply being good just isn't enough anymore. To keep this momentum going, corporate earnings don't just need to be solid, they must be absolutely flawless.
So here is the ultimate takeaway for us today. The real danger right now isn't a random black swan crash out of nowhere. The real danger is unmet expectations. When the market price is in absolute perfection, and the VIX is low because everyone just assumes things will keep going smoothly, it creates a deeply fragile environment. If inflation spikes or AI earnings disappoint even slightly, reality fails to meet those sky-high expectations. And that is exactly when a calm market suddenly turns volatile.
So how do we actually navigate all this? Well, instead of just sitting around worrying about a crash, we need a concrete, actionable roadmap. We need to pivot from just diagnosing the problem to actively monitoring the vital signs of the market. Moving forward, there are 3 very specific signals you should be tracking to see if this underlying narrative is starting to crack.
First, keep your eyes closely on the VIX for any sustained breakout. If it starts to climb and actually stays elevated, it means expectations are shifting. Second, watch options positioning. Specifically, if that downside SKEW insurance gets wildly expensive, it means the big money is actively reassessing risk. And third, watch those long-term treasury yields. If borrowing costs spike alongside inflation, those record-high stock valuations will absolutely crack under the pressure.
Let's wrap up with this final thought. I want to challenge you to shift your mindset a bit. Instead of constantly asking, will stocks crash? Ask yourself this. What would have to go wrong for today's perfectly priced expectations to change? The market isn't necessarily warning us of a collapse, it's challenging us to understand just how much good news is already priced in. Keep an eye on those expectations, and you'll always stay one step ahead. Thanks so much for joining me on this explainer, and keep learning.